In a crisis, stocks of financial companies are great investments, because the tide is bound to turn. Massive losses on bad loans and soured investments are irrelevant to value. Improving trends and future prospects are what matter, regardless of. Value investing is at its core the marriage of a contrarian streak and a calculator. Value investing is risk aversion. Value investing is predicated on the efficient market hypothesis being wrong. If you are predisposed to be patient, disciplined and psychologically appreciate the idea of buying bargains, then you're likely to be good at it. If you have a need for action, if you want to be involved in the new and exciting technological. In contrast to the speculator's preoccupation with rapid gain, value investors demonstrate their risk aversion by striving to avoid loss. To a value investor, investments come in three varieties: undervalued at one price, fairly valued at another price, and overvalued at still some higher price. The goal is to buy the first, avoid the second, and sell the third. Value in relation to price, not price alone, must determine your investment decisions. If you look to Mr. Market as a creator of investment opportunities, where price departs from underlying value, you have the makings of a value investor. Once you adopt a value investment strategy, any other investment behavior starts to seem like gambling. In a rising market, everyone makes money and a value philosophy is unnecessary. But because there is no certain way to predict what the market will do, one must follow a value philosophy at all times. Value investors will not invest in businesses that they cannot readily understand or ones they find excessively risky. Hence few value investors will own the shares of technology companies. Many also shun commercial banks, which they consider to have. One must understand the importance of an endless drive to get information and seek value. I find value investing to be a stimulating, intellectually challenging, ever-changing, and financially rewarding discipline. While knowing how to value businesses is essential for investment success, the first and perhaps most important step in the investment process is knowing where to look for opportunities. As Buffett has often observed, value investing is not a concept that can be learned and gradually applied over time. It is either absorbed and adopted at once, or it is never truly learned. There's no such thing as a value company. Price is all that matters. At some price, an asset is a buy, at another it's a hold, and at another it's a sell. When managers are afraid of redemptions, they get liquid. We all saw how many managers went from leveraged long in 2007 to huge net cash in 2008, when the right thing to do in terms of value would have been to do the opposite. Quotes famous. Thank you for watching.